Now, in regards to Amazon's stock price, right? It started to obviously move down after hours, which I'm like, thank you, thank you, thank you. So what happened here, okay? Well, I'll tell you exactly what happened here. Basically, the company is talking about AWS coming in slower for growth in the April quarter, okay? And so that caused a bunch of fear about what are the numbers going to be. So basically, this stock went from being up 10, 11% after hours at one point to now, who knows, it could be red tomorrow. We'll see what happens, okay? So this is like best case scenario for me because my bottom line is for Amazon, I'm buying this entire year. Until this year's over, I'm buying this entire year for Amazon. So I want as many shares as possible for as cheap as possible. So thank goodness they pulled that a rabbit out of their hat and, hurt the stock in the short term. I can understand for people that are maybe playing short-term calls and things like that. You're not happy with this, okay? You want it just to be positive vibes. But for me, this is the best case scenario. The worst case scenario was the stock just goes on a ripper and, is 120 plus tomorrow and, heads to 130, 140. I want as many shares for as cheap as possible. Thank you for that commentary, Amazon. I appreciate it. The green numbers I have here are basically good numbers I like. The red is numbers I don't like, okay? Now, I was actually impressed by net product sales. They came in with growth year over year. Now, is it much growth? No, $500 million, which isn't much for Amazon. But keep in mind, UPS, they reported negative 6% revenue numbers, if I recall, okay? So that made me actually fearful of like, wow, could as far as product sales, could Amazon be negative? And to come in with growth, I was happy with that after those UPS numbers, okay? Now, net service sales obviously came in with a tremendous growth, over $10 billion of growth there. And so I was happy with overall revenue growth of, nearly $11 billion. I'm happy with that. Cost of sales, I'm also happy. Didn't see a huge uptick in cost of sales, so I'm happy with that number. Fulfillment, didn't see a massive uptick there. I'm happy with that. Technology and content, not happy with that. They grew almost $6 billion on a year-over-year basis. Technology and content, they've been spending like crazy there. I hope it pays off, but not thrilled with that in this environment. Sales and marketing, also not thrilled with that, up almost $2 billion on a year-over-year basis. As far as general and administrative, that's fine. That's in line, okay? As far as total operating expenses, up almost $10 billion on a year-over-year basis. Not happy with that. I would have loved to see that be a much lower number, but really it's coming from that technology and content area. That's killing them right now, okay? Operating income, happy with, obviously being up nicely on a year-over-year basis. Income before income taxes, $4.1 billion, happy with that. Do keep in mind, once again, last year they had that huge Rivian expense in there, so do keep that in mind. And net income obviously being positive, $3.1 billion. Happy with that. EPS came in better than I expected. I was really scared that they were going to miss as far as EPS went. For them to come in with a nice beat, analysts, I believe, were at 22 cents of EPS expected. For them to come in 31 cents. Happy with that overall. So overall, the earnings were better than I expected. They were, no doubt, they were better than I expected. As far as balance sheet goes, this once again looks at a quarter-over-quarter basis, not a year-over-year, but total assets were up nearly $2 billion on a year-over-year basis here. And as far as total stockholder equity, that's a pretty substantial move there to $154 billion from $146 billion in the same quarter, in the previous quarter, okay, on a sequential basis here. So happy with the balance sheet overall, happy with the income statement. And overall, the earnings were better than I had feared. Obviously, phenomenal day for me today out there, right? And I hope it was for you guys as well. We were up $73,000 today in the public account. Absolutely insane, massive day, right? And it was led by Meta. And this was this stock alone we were up $53,000 here today just in the public account with my Meta shares, $53,000. So, the interesting thing about that is, okay, the stock could have been up a lot more. But why was it not up even more? Okay, and it had a good day, but it could have been up even more. There was something I thought held back the stock, actually. I think the stock could have made an 18 to 20% move here today. But there was something that happened on that conference call. And what happened was they left the door open for more potential hiring in 2024. And that is I don't want to say a change of approach, but on the last conference call, and especially, if we even go back to the last two conference calls, Zuckerberg really was talking about efficiency. They're still talking about efficiency. But the fact that all of a sudden now they're opening up the door to more potential hiring in 2024, it leads people to kind of look at it and be like, wait, well, what's going to happen here? How much are they going to add to the employee force? Like 3%, 5%, 10%, 20%? Like, it leaves the door open to more uncertainty in terms of bringing down costs. And I think that actually held back the stock price a little bit here today. We need to get more clarity on that. Because, no one wants to see Meta go on a hiring spree again. I can tell you that. No investor out there wants to see Meta all of a sudden add up the employees again and get into a bloated cost structure again, okay? Zuckerberg has done so well with investors the last couple of quarters as he was talking about efficiency, streamlining the organization. And they did a bit of that on this conference call. But leaving that door open, that scares folks out there. Like, oh boy, what are they about to do here? Hire again? As far as me in regards to Meta, I was obviously, I'm happy with the move Meta makes because I'm happy with the position I built out. I don't need to buy more shares of Meta stock. I feel comfortable with what I have. Do I mind buying more Meta shares if the stock was to go down? Sure. Do I want to consider selling the stock? Absolutely not. It's not even close to being a sell for me. At this point in time, for me now, it's kind of a hold. And if we get any major drops, I'll end up picking up more shares of Meta, but I feel comfortable with my position. I mean, it's a $400,000+ position in the public account, and that's a portfolio that has $1.4 million. So, it's a pretty heavy weight in there, right? And obviously I put 222 into it, so basically it's about almost doubled up now at this point in time in terms of amount of money. So I don't worry about getting too overweight because of a stock going up in price. I more think about it in terms of me adding the position, actually putting the money in the stock. Tesla became such a big weight over time in the portfolio because the stock price went up. So I never really trip off that, okay? We put out this weekly investor report essentially, okay? And it just covers a ton of different stuff in there. One of the things we cover is 30-year fixed mortgage rates, okay? On average, current rate as of last week was about 6.4% roughly, okay? A year ago, we already seen as rates were getting high at 5.1%. So when it comes to overall, let's call mortgage rates, you're not going to see real estate really recover in terms of sales in a major way until we either have a huge amount of time pass where everybody gets used to paying a 6% plus mortgage rate, right? Which you're going to need a lot of time to take, or we need to get back down to something under 5%. Because the bottom line is everybody has gotten programmed for over a decade that it is normal to pay a 2 or 3% rate on a 30-year mortgage. You can't all of a sudden throw a 5, 6, 7% number and expect everybody to just run out and buy homes. It's not going to happen because everybody's been programmed that I have to wait till 3 or 4% because that's what my neighbor's at, that's what my parents are at, that's what this person's at, that's what my friends are at, all those sorts of things, right? All my mortgages are, twos and threes, right? On all my different homes. So, that's what people expect. So the bottom line is and also, they say, oh, the home builders, they're doing so great. They've got so many sales coming and blah, blah, blah. Oh, really? What about home builder confidence? What does that tell us? The home builder confidence index came in at 45 for April. It's up 2% from last month, but it's down 41.5% from a year ago. The home builders, their confidence is not high right now. So if anybody's trying to pitch that, the home builders have so many orders coming in and it's just going to continue to be great for them, they're in risky territory, folks. Home builder confidence being down that much year over year, I don't even know if it was down that much in the great financial crisis and then real estate collapse. That's extraordinary. This basically tells you that the home builders are not feeling good whatsoever, okay? So in terms of me personally, my views on real estate, my views on, do I think the real estate market, when do I expect it to start coming back? Am I going to look for a real estate investment property, those sorts of things, okay? So my opinion is, if we can get mortgage rates to continue to come down without unemployment going up in any substantial way over this next 6 months, I believe we can bottom out real estate over the next 6 months and actually see some nice upward momentum. If mortgage rates start shooting back up again, we're going to be in trouble, and that's not going to be a recovery, okay? And the problem is we're in prime selling season right now. Like this is the hot time of year to sell, okay? Is in the springtime. So we need orders to come in. If we don't see those orders come in, it's going to be a world of hurt for the home builders. Also, they'll feel the effects. Now, the good thing for home builders is a lot of people aren't selling their homes because they're locked in at 2 and 3% rates. Why would you sell your home right now at a 2 or 3% rate to go buy another home at 6.4%? Why would you do that? Like anybody that has a brain, knows like I'm not going to do that. The only people that are looking to move are somebody that has to move, right? Literally your house is like too small, you had kids and you're like I need to get out of here, right? Or people that have far too much money. But the people that have far too much money, a lot of them aren't spending that money right now. And if they do, they could buy cash, right? But when we come to luxury home sales are horrible right now. RH CEO, who's the highest end furniture company that sells to luxury homes, right? He says that this is the worst market he's pretty much ever seen. He says it's worse for luxury homes than actually in the great financial crisis. And that was his commentary. So in terms of the luxury home market, that's not doing so well. So I'm going to be interested in a real estate investment property, but I'm looking more at either the very end of this year or potentially 2024 or 2025 for buying another real estate investment property. Last year was certainly a boycott year for me for real estate. Like, heck no, okay? In this year, like I said, if I do, it would be at the very end of the year. I'm not in a rush to say I got to go, buy something right now in this sort of market, and especially given, you have different places for your money. So why would I necessarily put the money there when treasuries are still getting 5%? Guaranteed money, right? Savings accounts, guaranteed money giving you 4-something%. And then there's a lot of stock opportunities out there, especially with value and dividend stocks. There's some growth stocks out there that are opportunities, but really a lot of opportunities in value stocks and dividend stocks right now. So from my standpoint, I'm be looking for a property, but I'm in no rush. Let's just call it that. Real estate market moves slow. You have every once in a while where it moves super fast, like obviously coming out of Rona, the market went super high, but that's not normal. Market moves slow to the downside, slow to the upside. It does not move fast. That's a very rare situation, okay? So when real estate does start to bounce back, and we actually bottom this baby out, which we have not done that yet. When we do, it'll be a slow movement up, okay? So do keep that in mind. It's not like the stock market where it's like, shoots off like a rocket ship, and next thing you know, stocks up 75%, 100%, 150%. Stock market, you got to be fast. You got to work with urgency in the stock market. Real estate market, you don't have to work with urgency. And if you ever feel like you got to work with urgency in the real estate market, because that's a time period when you're in a bubble, okay? Because the only time period you could really say you had to work with that much urgency was probably 2005, 2006, and like 2021, okay? Outside of that, you should not have to work with that sort of urgency in the real estate market, or something is wrong, or you live in LA, one of those two scenarios. So